Hey YouTube, Jason here with DayTradingFearless. Welcome back to my channel. If you're new, welcome. Make sure you guys like and subscribe to my channel. And as always, let's jump right into it. So today we're going to be actually talking about what a call option is, okay? To kind of keep these things real simple, basic, and all that. And I'm also going to kind of teach you and show you around on the Thinkorswim platform, easy ways to do things and all that, how to read it. So right here, if you type in the symbol Apple, you have your underlying, right? Your last net change, bid ask, all that of the stock. If you drop this down, you actually have last size traded, if it pays a yield, volume, shares, all that stuff, okay? Second, if you open up the option chain right here, okay, you have all your different strikes. The weeklies are going to be in yellow. The monthlies are going to be in May. Easiest way to read this is 8 May 20. So that's the 8th day of May, the year 2020. Okay. So there's 2 days left. Okay. Which these expire on this Friday. So because today's Wednesday, so you have 2 more days, Wednesday, Friday. Here you have 9 days for the monthly, May 15th, 2020, with 9 days left. And the 100 represents how many shares per one contract. So all these are monthlies. And then all a leap option is, if you don't understand what leaps are, all leaps are is when you go out farther out, like you go out maybe 6 months to 2 years, right? So if I want, I could buy some leap options, quote, right? For June of 2022. Well, that's 2 years away. I could go and buy the 300 calls for about $57, right? Or $5,700. So, so that's how you read that. Then over here, this is the way I have mine set up, and this is all I really care about. I care about theo price, which is the theoretical price, also known as the mid price, right? So for 40 by 45, 42.5 would be the mid price, okay? That's all the theoretical price is. Then I have delta, okay? Delta, think of it as one of 2 ways. Keep it simple, basic, all that. And all it is what are the odds of it touching? So the odds in the next 9 days of the 315 getting touch is about 19%, okay? So then another way to look at the delta is if I bought these right now for $1.33, okay, for every $1 price of the move, either up or down, the option is going to change by 19 cents, right? So if I buy these for $1.32, realistically, the stock moves $1 really quick. Add 19 cents to the 132, and then that's your number. So what, 142, 151, the option would be worth. That's a good way. Now, as it gets in the money or out of the money, all these, the shaded area is in the money, meaning there's intrinsic value, right? With extrinsic value, but out of the money is all extrinsic value only. Another word for extrinsic value would be premium, okay? So just a quick kind of run through of understanding all this. So going back to sum that up, the delta is one of 2 things, okay? Let's keep it simple. We don't need to get too complicated and make it harder than it really is. These are what's the dollar move. For every $1 move higher or lower, the option will move whatever the delta is. So if I buy the 302s for $5.75 and the stock goes from 303 to 304, okay, that's a $1 move. these options will gain about 52 cents. Also, what are the odds of closing in the money or at the money, right, is about 52%. So there's a 19% at these 315s, about a 19% chance that the option will close in the money of 315. So there's a 81% chance that they won't. So if you buy this option, you have a 19% chance of making money at expiration, or a 81% chance of losing. Okay, so that's kind of a simple way to look at it. Next, we have volume. Okay, this is how much volume has traded for the day. So we could see there's 10,000 contracts here, okay, that have traded today. Now, open interest, and that volume could be either on the buy or the sell side. On the open interest, these are how many contracts are open, okay, as of today. So if you think about it, if we actually have 10,000 contracts, but we have open interest of 15,000, okay, well, we know yesterday that number was probably around the $5,000 level. So hopefully that helps. Then we have our bid and our ask, and these are calls. We come over here, these are puts, okay? These are the put side, and the same exact things the same way. Over here, we actually talk about the interest, okay? This is, implied volatility. So right now, these contracts on Apple are at 33% with 2 days left. The monthlies have a 33% chance, and so on, okay? Now, if we look down here, we could see 34, 35, there's time, anything can happen, but all of a sudden you have 38% here, but then this contract, okay, this October is at 37. Well, why is this higher than the October? So it's higher than this, the July, and it's also higher than the October. The reason being is because more than likely they have a news event during that cycle or their earnings report, right? So I could just tell that it's higher because there's going to be earnings, so it's already built into the options. Okay, so what exactly is a call and what's the basics of a call? Keep it simple. If you think the stock is going higher, you could buy an at-the-money call. Okay, let's use the 300 strike. If I could buy it for $730, okay, which would be per share multiplied by 100, that would be $730. Remember, one contract represents 100 shares of the stock, right? So we need to multiply this 730 by 100. So if we were to buy this, okay, we click buy 730, right? We'll lock that price in. Okay, single buy, one contract, of Apple, May 20, okay, May 15th, 2020. The strike is 300, the call. If we want the put, we would just change it to put, okay, but we're going to do call. And it's $7.30 day, and then the exchange. If I click confirm and send one time, here we could see the break even of this would be 700 or 307. So we would need the stock to be above 307.30, okay, by expiration. All we're doing is we're taking this 300, adding 715, okay, or in this case 730 to the price, okay, add that plus that becomes your break even. My max profit is infinity. There's no because there's no level. Remember, a stock could only go to zero, so my max loss would be $730 if this option expired worthless. But on the upside, I can make as much as I want. The stock could go to 400, right? And then I would essentially make about $4,000 if it did that within the next 9 days. Cost of trade, right? And then your buying power effect is only $730. And so that's how this works, okay? Now, if you are bullish, you would buy on the ask. If you're bearish, okay, on the call, meaning let's go out. Normally, you don't want to buy in the money calls. You want to buy out of the money calls. The reason being is you want to give yourself time to be right and also direction. So I could sit here and think about this for a minute. I could go and sell with these 315 calls. Okay. If I sell them, you'll see I'm selling one, right? Apple 315 call for $1.30. Okay, we'll bring that back down to $1.30. Well, what I'm essentially saying is I'm taking the other side of the buyer. So if there's somebody buying, they need the stock to go to 315 plus $1.32 or $1.30. We'll use that number, right? $1.30, that would be $316.30 of the stock price before they start to make money. So that's the buyer. Well, it's kind of like, hey, you want the Raiders to win. Well, I want Green Bay to win. They're playing each other. One takes one side of the trade, the other takes the other, and there's going to be a winner and loser out of the two of us, right? So if I'm selling this this call, okay, for $1.30, let's now look at the breakdown. My break even is $316.30. So this stock could go, we're at 303, we'll round it up, right? This stock can move, $13 higher to $16.30. So it can move $16 or $13.30 at expiration before I start to lose money. Now, if it closes below 315 of my strike, I keep the whole $130, okay? If it goes above 316, I start to lose dollar for dollar, right? Now, my buying power is going to be a lot more expensive. I need to put up about $5,000 worth of cash because, remember, I have unlimited losses while the person who buys the call has limited losses. They can only lose what they pay for it. But they have to be correct directionally and by time, right? So they need the stock to move $13.15 where we're at right now in the next 9 days to make money on this. On the flip side, I could be dead wrong on the direction. This stock could still move $5 higher come expiration and still lose. Still make money, right? While the buyer, all at expiration, lose all his money. Now, the reason I keep saying at expiration is because at expiration is when the option settles. But I could have bought this here for $1.30. I can now sell it for $1.34, just a quick little move of the stock price, and I can make a quick $4 on the trade and turn around and sell it very quickly and capture a win and go sell to somebody else, right? And there's always a bid ask, and that's what market makers are, is when there's not another buyer or seller, they step in and make a market. So that's a quick description on what a call option is and kind of how to use the Thinkorswim platform. And I will do other options in the future. So As always, thank you, and we'll talk to you next time.